let's talk about a powerful trading signal that could completely change how you enter the market. It's called the first pullback, and it's all about a simple shift from trading harder to trading smarter. Let's get right into it. We have all been there. You see a price just taking off, that FOMO kicks in, and you jump in only to watch it immediately dip, stopping you out for a loss. It's one of the most frustrating feelings in trading, and it really feels like the market has it out for you personally. But what if there's a much better way to play it? It really comes down to a tale of two entries. On one hand, you've got the chase. That's where you enter at the peak, you're taking on a ton of risk, and your stress levels are through the roof. But on the other hand, you have the wait. That's entering at a discount, which means way lower risk and honestly, a lot less anxiety. This choice is at the very core of what we're going to break down today. So, the solution to this whole chase and lose cycle has a name: the first pullback signal. And the reason it's so incredibly powerful is that once you know what to look for, you will start seeing it absolutely everywhere. So what is it exactly? Well, think about it. When a trend changes direction, it almost never just blasts off in a perfectly straight line. Right after that initial big move, there's almost always a little dip, a little breather, before the new trend really continues. That dip is the first pullback, and that's our golden opportunity. And I'm not talking about some obscure once-in-a-blue moon pattern. Whether you're staring at a 4-hour Bitcoin chart, a daily chart of gold, or even good old Apple stock, this pattern shows up time and time again. Its universality is what makes it such a reliable concept to build a strategy around. Okay, so we know what it is, but why does waiting win? Why is it so much better than just jumping on that first explosive move? Well, it all comes down to some really simple math and smart risk management. The single most crucial factor is this: your risk-to-reward ratio. Put simply, that's just how much profit you're trying to make compared to how much you're willing to risk if the trade goes south. Waiting for that pullback dramatically, and I mean dramatically, shifts this ratio in your favor. Let's just walk through the path of impatience for a second. You get excited, you enter at the absolute peak. Then, the natural pullback happens, and because your entry point was so high up, even a tiny dip is enough to hit your stop loss and kick you out of the trade. It's a predictable recipe for disaster. Now, let's look at the path of patience. You spot that pullback happening. You get to enter at a much better price, basically at a discount. This means you can set a tighter stop loss, so you're risking less money. But your potential profit, if the trend continues, is way bigger. It's a win-win. Smaller risk, bigger reward. All right, that's enough of the theory. Let's get really practical. Here's a clear 3-step plan for how you can actually start trading the first pullback. Step 1 is all about spotting a valid trend reversal. And I really can't stress this enough. This is the most important part. If you get this step wrong, the entire strategy completely falls apart because you're trading a pattern that isn't really there yet. So what in the world makes a reversal valid? It really comes down to identifying the right market structure. For a low to be considered a key structural point, a valid low, the move that comes after it has to be strong enough to actually break above the previous high. If it fails to do that, that low is just noise, not a real turning point. And here's the difference in a nutshell. Breaking an invalid low doesn't really mean the uptrend is over. But when you see a candle close below a valid low, that's your confirmation. That's the signal that the trend has truly reversed, and now we can finally start looking for our first pullback. So you have 2 main ways to confirm this. The first and best is just a clear candle close beyond that valid structural point. But hey, sometimes charts are messy, right? If things look a bit unclear, you can bring in a momentum indicator like the MACD. A cross on that indicator can be a great secondary confirmation that, yep, this reversal is the real deal. Okay, on to step 2. Once we've confirmed a real reversal is in play, our next mission is to figure out where that first pullback is likely to end. This is how we find our perfect entry point. Our first method for finding the sweet spot is using supply and demand zones. These are simply the areas on a chart right before a big, explosive, impulsive move happened. The thinking is that a lot of big orders were placed there, so price is probably going to react if it ever comes back to that zone. You just find the last candle before the impulse and mark that area. But what if you can't spot a nice, clean supply and demand zone? No worries. There's another excellent tool for the job: the Fibonacci retracement. You just draw it from the low to the high of that big reversal move, and it'll automatically plot key potential levels where the price might pull back to. And of all the levels that Fibonacci tool gives you, this is the one you need to watch like a hawk, the 61.8% level. It's often called the golden zone, and for good reason. It's where price most commonly pulls back to in a healthy, trending market. It's an incredibly reliable area to look for your entry. And finally, we're at step 3, execution. The key here is pure discipline. You are not manually clicking buy or sell when you see the price getting close. Instead, you use a limit order. This is just an instruction to your broker to only execute a trade at a specific price or better. You place it at your chosen level and you let the market come to you. And here's your simple checklist. Your entry is at your predefined level. Your stop loss goes just on the other side of that zone to protect you. And your take profit target? It should be at least double what you're risking. That's how you make sure your winners are always bigger than your losers. You set it, and you forget it. Now, what's really amazing about this whole concept is that it's not just a standalone strategy. It's a principle, a mindset that you can apply to make other strategies you might already be using even better. I mean, think about a classic breakout trade. The price smashes through a key level. The temptation is to chase it, right? But what's the smarter play? You wait for the first pullback, where the price comes back to retest that same level it just broke. That is a much, much safer, higher probability entry. And this really gets to the core mindset behind this whole approach. Look, sometimes the price will just break out and never look back. It won't pull back. You'll miss the trade. And that's perfectly okay, because missing an opportunity is infinitely better than forcing a bad entry and taking a loss. Patience is your greatest asset. So, as we wrap this up, the final question is really for you. Armed with this knowledge of the first pullback, what's the next high probability, patient trade you're going to wait for instead of just chasing the first move you see? Thanks for watching.